Now, if you've ever wondered how long will it take to get my money back from an investment, the payback period is exactly the tool you need. Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're diving into a topic that's super useful for both businesses and individuals: the payback period. By the end of this video, you'll know exactly what the payback period is, how to calculate it, and when it's useful for making financial decisions. So let's get into it. Okay, so what exactly is the payback period? Simply put, the payback period is the amount of time it takes to recover your initial investment from the cash flows that the investment generates. It's a straightforward way to figure out how quickly you'll break even on a project, business venture, or even a personal investment. For example, imagine you invest £10,000 in a project, and that project generates £2,500 per year in cash flow. To calculate the payback period, you simply divide your initial investment by the annual cash flow. So payback period would equal initial investment divided by annual cash flow. In this case, £10,000 divided by 2,500 equals 4 years. That means it'll take you 4 years for you to recover your initial £10,000. Sounds simple? That's because it is. The payback period is one of the easiest ways to evaluate an investment. But here's the thing, it's not just for big companies. You can also use the payback period in your everyday life. Let's say you're considering buying a new car that costs £20,000 and you're planning to use it as a rideshare vehicle. If you estimate that you'll earn £5,000 per year from driving, your payback period would be 20,000 divided by 5,000, which gives you 4 years. This tells you that it will take you 4 years of rideshare earnings to fully pay for the car. The shorter the payback period, the quicker you recover your investment, and the less risky the decision becomes. That's why businesses and investors love this method for evaluating projects and purchases. Now let's take it a step further. The payback period can also work for projects with uneven cash flows, where the returns vary year to year. So here's an example. Imagine you invest £10,000 in a project and it generates the following cash flows. In year 1, £3,000, in year 2, £4,000, and in year 3, £5,000. To calculate the payback period, you add up the cash flows year by year until they equal your initial investment. So after year 1, £3,000 is recovered. After year 2, £3,000 plus £4,000, which is £7,000, is recovered. And after year 3, £7,000 plus £5,000, which gives you £12,000, is recovered. So by the end of year 2, you've recovered £7,000, and in year 3, you recover the final £3,000. So the payback period is actually 2.6 years, and that's 2 full years plus a portion of year 3. It's a little more work, but the process is still pretty straightforward. So why is the payback period useful? Well, first, it's a great way to measure risk. The shorter the payback period, the quicker you recover your money, which reduces the risk of the investment going bad. For example, if you're investing in something uncertain, like a new product or a business expansion, a shorter payback period gives you more confidence. Second, it's easy to understand and calculate. Unlike other financial metrics that involve complex formulas, the payback period is simple and doesn't require a finance degree to figure it out. But here's the catch. The payback period has its limitations. It doesn't consider the time value of money. £1 today is worth more than £1 in the future, but the payback period doesn't factor this in. It treats all cash flows as if they have the same value. Second, it ignores cash flows that happen after the payback period. So let's say 2 projects both have a payback period of 3 years. One project continues to generate cash for 10 years, while the other stops after 3 years. The payback period wouldn't show you this difference. Now, because of these limitations, the payback period is often used alongside other tools like net present value or NPV, or internal rate of return, IRR, to make better decisions. So let's recap. The payback period is the time it takes to recover your initial investment. It's simple to calculate, easy to understand, and great for measuring risk, especially for short-term projects or personal decisions. However, it doesn't account for the time value of money or cash flows after the break-even point. So it's best to use it with other metrics for a complete picture. And that's it. Payback period explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.